Okay, great stuff. So, subsequent measurement of financial liabilities, or if you like, I guess initial, really, just coming back here. So you see, it's saying that at initial recognition, an entity shall measure a financial liability of its fair value. Now, what does that actually even mean? Now, I've said this before. Any assets and liabilities are really the present value of their, if you like, of their future cash flows. For example, if I say to you that, listen, I'm going to pay you £1,300 in year three, I'm going to pay you £100 in year two, and I'm going to pay you £100 in year one. I guess the question here is, well, how much have I really borrowed from you? Well, what I'm really, if you like, the question here is, what is the present value? Because this is how it really works in reality. You see, it's not really, it works kind of backwards. You see, because like I said to you, you would only lend me money if it was going to be fair to you. So if the market rate, if the bank rate is 10%, you would then say to yourself, well, I'm going to work backwards and see what 10%, what the present value using 10% is. And you would work all of that backwards. And I don't know, I'm just guessing the present value. I could do it, but it's just 1,300 divided by 1.1 raised to the power of 3 and 100 divided by 1.1. Key point here is I'm just going to assume, imagine this was 1,100 and this is the 1,100 bit, 300 bit. Imagine, oops, sorry, that's bit. And imagine this 100 here was 90, and imagine, sorry, this was 80, 80, 80, and imagine this was 90. This one was 90, and this one was 80. So it only means that you would therefore lend me, if you like, you would say, "Oh, no problem, Oyen, I will lend you, here we have 1,000, this is 170. You would lend me 1,270 now. Because you know that if you put 1,270 in the bank, in a year's time you would get 100. In another year you get 100, and in another year you get 1,300. You won't lend me anything more. You might lend me less because you'd be making a profit, right? Right? You would, but you wouldn't lend me anything more. If you lend me anything more, well, you've just given me free money. This is the present value of what I've promised you. I've promised you, if you like, student, to give you these three amounts, but the present value, today's value of these three amounts is equal to 1,270, and that's exactly what you will give me. So my liability must recognize, when I write financial liability, I must put 1,270. You see, because like I say, what will happen over the period of time is that I will accrue interest. Interest will accrue, if you like, on this loan, and it will grow year on year till it gets to this final amount, and then we will, if you like, I will pay. So that's kind of how we deal with this. So again here, yeah. So that's the first thing. Then this is often the net proceeds being the cash received less any issue costs. So sometimes what you'll see here is that issue costs are allowed because they're really in the long term. You can deduct the issue costs from the loan. So what does that mean? So for example, I borrowed money. Say I borrowed £1,000. Then thank you very much. I recognize the loan, £1,000, and the issue costs, if you like, are for say 150. So what I am allowed to do, if you like, is to, I've got bank here. Oh, sorry, this is bank, of course, bank. So you've paid £100 of issue costs. You can, if you like, deduct that issue cost from the 1,000. In fact, what I should even say is that all of this is factored in calculating or arriving at the effective interest rate. All of this is planned right from the beginning. It's not it's not started, the thinking doesn't start at the beginning. This thinking starts given all the receipts, given all the issue costs, what is the effective interest rate that we're going to use to arrive at that final payment that must be made, right? So your effective interest rate has already been worked out for you with the pre-knowledge of issue costs, the pre-knowledge of final payments, of individual cash payments, right? And this is recognized over that period steadily. So amortize just says we're recognizing interest costs, cash payments, and just going on year and going through it that way. And that's what I sort of talk about here. Right. So again, I'm just highlighting the fact that you have an agreement at the start and at the end of what you will borrow now and what you will pay at the end. And we will just want to kind of classify and measure what's going on over the period. So typically, because we're really dealing with loans and debts and debentures and that sort of thing, you can see here it says that amortized cost is calculated as the initial value, if you like, which is that kind of fair value, present value of those payments, plus the effective. Listen, this would have been simple. Say, for example, you weren't paying any money at all. So say, for example, you're not paying any interest. You're just saying, give me £1,000 now, or in, and I will give you 1,300 in the future. So that's the fair value that I recognize now, if you like, debit bank 1,000. And then all I do is I just literally recognize the interest of, I gave you the example of 10%, finance cost 10% or 100, carry down 1,100, brought down 1,100, do exactly the same again year on year. But if I'm paying any cash toward against that, if you like, call this the coupon rate, I'm reducing that liability and then calculating interest rates, calculating the effective interest rate again on the closing balance. And this is happening year on year until I arrive at the final payment at the end of the life. So again, like this idea of a deep discount bond is literally saying that you're literally saying that the cash paid, the interest paid is not the same thing as the effective, it's not equal to it. So you're not paying, you're not clearing the effective interest rate year on year, technically. So like I said, £1,000, 10%, we've agreed that I will pay you, well, we've agreed technically the bank would pay me it's a case of 10% will accrue every single year. You have the option of not paying anything, so that's a full discount of 0%, or you might decide to pay some of it, 5%, or you might decide to clear it. So you'd give me literally the amount that accrues every year. So literally, again, it's important I do this because so you can understand it in so many ways. That's the loan. 100 accrues, you pay me, right? That's bank. You pay me coming out of your bank £100, you clear that interest every single year. This is no discount on the cash payment, on the interest. But you might decide, you know what, Oyen, I'll just give you 50. So if you give me 50, you will see that in effect, by the time you do it the next month, the interest will be higher because you haven't fully cleared the interest, and that's what's referred to as a deep discount bond, where the cash payment or the coupon rate is not equal to the effective interest. Yes, so that we always come back to just principal at the end of every cycle, right? Good. So just to highlight that again, ultimately, if it's not a discounted bond, I will clear the interest every single year and only ever owe the principal at the end of every period, year on year, until I get to the end when I just pay off the principal. Anything else will mean that I'm paying less than the actual effective interest rate. Effective interest rate continues to increase, and I'm paying more than the principal by the end of the period. Okay, great. So let's let's look at now I'm going to go to the textbook and sort of see look at what they're doing. I probably won't. Oops, sorry. Yeah. Yes, so let's look at this. I'll just use this. Look at this illustration. So it says here that you have a loan note for 1,000. They're telling us what this is the agreement. You 1,000 now, and you will pay back 1,250. It's going to happen over 5 years, and interest is paid at 5.9 per annum. So this is the coupon rate, the cash payment. You've agreed to pay 5.9% on this £1,000 every single year. You're saying, oh, and I'm going to pay 5.9% towards the principal. Well, or towards principal and capital. And it's been worked out that with this kind of arrangement, the effective interest rate is 10%. This is the result of this relationship, the effective interest rate being 10%, given that this is what you choose to pay. If you had chosen to pay another amount, the effective interest rate would be different, right? But you have chosen to pay 5.9% of 1,000, which is really £59, right? So that's what you're going to see coming out of your bank towards this loan. So when you look at a bank statement, you will see if you have a loan, that's what you're paying, that interest, but what's being recorded as finance costs is different, of course, if you're not paying the same thing. Okay, great. So first of all, like we said, we need to recognize this at the amortized. So the debt would be initially recognized for £1,000. There are no issue costs in this question. So just kind of, I mean, again, I'll show you the table, then I'll do it via double entry so you can see what's going on again. You have £1,000, and then what you first of all have, of course, is that imagine you had this loan. The interest will accrue on the loan. The interest of 10% will accrue on the loan, first of all, and then you'll see the payment coming out at the end of the year. So what you see here is you have £1,000. That's the finance cost at 10%. It's always on the closing balance. So you have 1,000, well, in this case, the opening balance here, it's always on the opening balance, forgive me, 1,000, 10%, and then you're paying 59 off, and so the closing balance on your loan is 1,041. Just think of any loan that you were taking out. So you open the year with 1,041. The finance cost again gets 10% on the balance, grows on that. You pay 59 and you keep on going, and you see that year on year, by the time you get to the fifth year, the final year, there's a finance cost again, and of course you now pay off the premium of 1,250 plus the 59 that you've agreed to pay every single year on the face value, right? That's what you're always doing. You've agreed to pay 5.9 £59 every single year, 5.9% on that £1,000. And this was, if you like, this is referred to as the coupon rate. If you had just decided, listen, you know what, I'm going to, because the coupon rate, when this business started, this whole business of borrowing money like this, the coupon rate used to be 10%. It was the same thing. Right, so technically, if this had been 100, you literally have 1,000 plus 100 minus 100. This would be 1,000. You have exactly the same 100, 100, 100, 100, and you just pay the principal back. But because you've chosen to pay less, but that we must know what that less is. So it's a fixed amount, if you like, on the figure. And this is what I was talking about earlier on about these coupon rates. You know, you've borrowed £1,000 and you've agreed to pay £59. You know, now I'm recording the accounts for the people who have borrowed the money. You've agreed to pay £59 every year coupon. So the effective interest rate, to make sure you get your final money at the end, must take that into account. So that's your coupon rate. From a double entry point of view, what you really had here was 1,000. Here was your liability of 1,000. Already worked out for you at present value, right? It must be the present value. No one's asking you to work out the present value here when you're recording it. What you then have, of course, you have the interest accrue, the interest will accrue of 100. So that was finance cost for you, 100, but you paid 59 out of your bank account. Bank 59. I mean, you received £1,000 at the beginning of the year, so you've paid 59 at the end of the year, and then you have your carry down figure of 1041, and the whole thing starts again, where interest accrues again of 100, if you like, of 104, and then we have 104, you pay 59, and you carry on, and you can see that's what we're doing in the table. Awesome. Awesome, guys. Okay, great stuff. And that's kind of the end of that video, but I'll carry on in the next. So basically, this is how we recognize these loans and debentures over the life of the term.